In this example, we're looking at cash budgeted receipts and payments for a company. So cash budgets are extremely important to prepare because we want to have an idea of what our cash receipts are from accounts receivable and other transactions so that we make sure that we have enough cash on hand to pay any monthly bills that we project are going to come due. So first we're going to look at collections of receivables. We have information about this company. We know that we have a note due at the end of the month. We're preparing a cash budget for November. We have cash on hand at the beginning of the month at $29,600. And then for our accounts receivables, it tells us that we collect 70% of them during the month of the sale, 20% in the following month, 7% in the second month following the sale, and that 3% are uncollectible. We sell various products at an average price of $11 per unit. So first, let's figure out what our sales are. So we have $11 and we want to calculate our total sales. So we take the number of units times $11. And we calculate our sales for each month, our projected sales, our actual sales for September and October, and projected sales for November and December. Then we're going to look at this cash budget. So first we start with the cash on hand, $29,600. We also have information here that we're selling a piece of depreciated equipment for $8,400 in cash. So $8,400 in cash receipts. Now we need to figure out what our collection on collectibles is. So if we come down here, we're going to determine what we collect in each month during the month of November. So remember it said we collect 70% of accounts receivables during the month of sale. So we're doing November, so 70% of November's sales will be collected. So we take November's sales times 70%. Then it tells us that 20% is collected in the month following the sale. So in November, we're following the month of October, which means we're going to collect 20% of the accounts receivables from October's sales. So we take October's sales times 20%. And then our last collection is 2 months following the sale. So in November, 2 months is following September. So in November, we're going to collect 7 months of their accounts receivable resulting from September sales. So September sales times 7%. We add those up, and that is our total collections on receivables during the month of November. So we have our collections of receivables. We add those collections along with our cash on hand at the beginning of the month, and that tells us how much cash we have available to pay our bills during the month of November. So we know we have a lot of payments. First, we know that we have that note payable of $98,500. Then we also have operating expenses. So it tells us right here that we have operating expenses of $220,000. But we need to know if all of that is paid out in cash. And we see here that we have depreciation of $35,000. Well, we know that depreciation is a non-cash expense. So that depreciation is not part of our cash payments out of these expenses of $220,000. And all of our operating expenses are paid in the month which they are incurred. So our November payments on operating expenses $220,000 minus $35,000. And now we need to calculate how much merchandise we purchased for sale and what the payments on those purchases are going to be. So we have a lot of information to look at here. First, purchases are payable within 15 days. So 50% of the purchase in a given month is paid in the following month. So our October purchases, 50% are paid in October and 50% are paid in November. And of our November purchases, 50% are paid in November and 50% are paid in December. Our average cost of units purchased is $7 per unit. We also like to maintain inventory at the end of each month of 2,000 units plus 10% of the number of units that will be sold in the following month. Our inventory on October 1st was 8,000 units. So we have a schedule down here so we can plan what our inventory purchases are. So we know that our ending September inventory was 8,000 units because it told us that. Then we need to know how many units we need available in October so that we can decide how many purchases we need to make. So remember, what we need available is the amount we're selling in October, 2,000 units, plus 10% of November's sales. That is right here. The amount for the month, 2,000 units, plus 10% of the number of units. So we have the actual October sales plus 2,000 units plus November sales times 10%. So we need 70,000 units in October. We started October with 8,000 units. So in October, we need to purchase another 62,000 in order to have enough available. Our purchase price is $7 per unit. So 62,000 times $7. Now we have our October purchases. We need to calculate what our November purchases are. So we have 60,000 sales in October. So our inventory at the end of October is 70,000 minus 60,000. We now need to know what we need available for November. So we need the amount for November's sales plus a 2,000 unit ending inventory plus 10% of December sales. So November sales in units plus 2,000 units plus December's units times 10%. So we need total of 87,000 units. We started the month with 10,000, so we need to purchase an additional 77,000 to finish the month. So our November purchases are 77,000 units times $7. Now we can determine what we're paying out. So remember, we pay 50% in the month, 50% after. So in November, we're going to pay 50% of October's purchases and 50% of November's purchases. So 434,000 times 50% and 539,000 times 50%. We add those together, and that gives us our total payments for merchandise during November. Okay, now we take our total cash available minus the total of all of our payments out, and we have a projected cash balance at the end of November of $46,800. We have a positive balance, so we don't have to worry about being short for any of our planned November purchases or payments. The last example that we're going to look at is a flexible budget. So the purpose of flexible budgets are that we can evaluate the performance based on what the budget would have been for our actual production when our production varies from what was budgeted. So we have up here, we have that we budgeted for 10,000 units, but we actually produced 11,000 units. So if we were going to evaluate this production manager based on his budget to actual performance, we would see that he went over cost in every category except for overhead. But it's really not a fair comparison because in going over cost, he produced an additional 1,000 units. So we need to prepare what that budget would have looked like at 11,000 units. And that's what a flexible budget does. It gives us different budgeted amounts for different levels of volume. So our actual amounts down here are exactly what's given up here for our actual results. So we just need to bring all of that down and add it together. To calculate what our flexible budget amounts are, we need a per unit amount from our $10,000 unit budget. So we need to take the budgeted production for 10,000 units, the total cost divided by 10,000 units to get the per unit cost, and then take that times 11,000. So we would take the cost of 310,000 divided by 10,000, and then take that amount times 11,000. We do the same thing for direct labor. We take our direct labor amount divided by 10,000 units times 11,000 units. And for the variable overhead, so our budgeted variable overhead amount divided by 10,000 units times 11,000 units. We don't need to do anything with fixed manufacturing overhead costs because if you remember from our cost behavior, fixed manufacturing overhead stays level in our relevant range of production. So that relevant range of production is the range of volume where fixed costs stay exactly the same, total fixed costs. So our fixed costs would be budgeted for any volume of production. So that's just $150,000. We add up all of our amounts and we have a flexible budget of $634,000. Then we look at the difference between the flexible budget and our actual expenses. So now we see that instead of going over costs, we actually saved money from everything that we had projected we were going to spend.